Alright folks, so here we are again from www.enejca.com. So this is another video lecture on share-based payment, IFRS 2. So what is a share-based payment? It's giving out shares in consideration to something which we have received. Maybe we have received a service and we are giving out share, or we might also be giving out right to purchase shares at cheaper price. So there, that will be an option. Or we might be giving out money according to the market price of the share. So here is an example. Example 1, purchase of asset. Suppose we buy a plant for 200,000, but we are giving shares of our company equal to the value of the plant. So we are buying a plant, but we are giving shares of our company equal to the value of the plant. So asset debit, share issuable credit. This is recorded immediately. Alright, so let's move on to another example. Okay, so here is share or cash alternative. Again, we might give options. These options are provided to directors for their stay into the company. They might be key employees. The condition here is to stay in the company for 3 years. These are extra to their salary. So these directors are key personnel of the company and we need them to stay more and more with us. So we will be giving them an extra benefit to their salaries. And the condition is they have to be with us for more than 3 years. So the options might be either take shares in 3 years time for the service provided, or take the cash $10 per share. So if we are offering 30,000 pieces of shares to our directors, we might give them an option. Either you take cash 10 per share, 10 into 30, it gives him a cash of $300,000, or take shares in 3 years time. So you take the shares and then sell it outside at a higher price and make a better benefit. So what happens is, if the share price increases, you take the shares and you sell it out. If the share price falls, you take 10 per share as a benefit. Done. So let's say the share price is now 10 per share and the company believes the price will increase by 10. That is, the price will become 20 per share in near future. In this case, it is guided by IFRS 2 to consider it as a cash settled transaction. Here we need to recognize a liability first. If the value of share or cash alternative is higher than the cash alternative, that is, value of the share or cash alternative, this is a terminology which we use it together, value of share or cash alternative is higher than cash alternative, then the excess portion is recognized in equity. So as we have seen in this example that it's something over a 3 years period, we need a discount rate. So here our discount rate is 10%. Recognize the liability at present value. From our previous studies, we know how to convert it into present value. The value of this type of contract will be higher than 10. So this is a contract, so value of the contract will be higher than 10. 10 is the share price which is at present, and 10 is the minimum share price for which they can buy shares after 3 years. That is, they can buy shares at a cheaper rate. So the value of this contract must be higher than 10, as there is a safety measure available. In any case, the option holder is not falling behind the $10 mark. So the option holder will never fall behind this $10 mark, because if the share price increases, take the share and sell it out and make a better benefit. If the share price decreases, you always have an option to buy the shares at 10. The contract price is given, which will be given in the examination, that is 15. Present value is calculated for $300,000 as this figure. This is the discount factor. So the present value is 300,000, which is this much for 3 years at the discount factor of 10%. Expense for year 1 is 15, which is the contract price. 30,000 is number of shares into pro rata for 1 year, that gives you this. So the liability is, this was the present value, so this is the liability for 1 year. The liability is this much. So expense debit 150,000, liability credit 75131. The remaining balance goes to the equity. We have discussed here the excess portion is recognized in equity. So at the year end, we again have a finance cost. Liability will unwind at 10% rate. So 75131 into 10% gives us this figure. Expense debit, liability credit. So this lecture is brought to you by Inage Chartered Academy. Hope we will be providing some more lectures. Please log on to www.enejca.com. This is Zakaria signing off from Inage TV. Thank you very much. Hope to see you in another lecture.